Hey, my name's Rajesh. I'm a direct lender based in Los Angeles, and today I'm going to show you how to turn $0 into $15.1 million. Let's get into it. Looks like it's a 9 unit property, so this is not a DSCR loan. We're going to look for um, whether it will qualify for an agency or bank loan. They're saying it's a 6.48 cap rate and a 10.23 gross rent multiplier, but then they also have the actual gross rents here and the net operating income here. So what we're going to do is see whether these numbers are actually hold up. So let's see what that looks like. Starting with the NOI. NOI is equal to price times cap rate. And that is a $2.25 million building. So 2.25 million times 6.48%. So this is actually considered expensive for Long Beach. I'm used to seeing something in the sevens, which is not too far off from 6.48, but this is still on the lower side of that range. So is that 2.25 million? Yep. Times 0.0648. That's 145,800. NOI, that's annually. And what does it say over here? 145,747. So this is what I will be using. 145,747 per year. Let's divide that by 12. So these two numbers aren't actually far off. So props to the realtors for being honest about it. Sometimes we've seen figures on this channel that are a little bit too far off to be considered usable. $58 per month. Okay. And now let's see the gross rent multiplier. So annual gross rents are equal to price over gross rent multiplier, which is equal to 2.25 million over, they are saying 10.23. So maybe my head is blocking it. 10.23. And they're saying market projections indicate a further upside at an 8.404 market cap and an 8.76 GRM. That means if you buy it and raise rents, you will get those numbers. So that means rents are currently below market rents, which explains why we're at a 6.48% cap rate, but 10.23 GM. So this is equal to that's 2.25 million, 10.23. So this is at 219,941.35 divided by 12. We are at 219. Well, first let's compare it to what this chart says here. They are saying 219,851 and effective gross income is 208,858. So that means if we were to use this number and enter a vacancy of 0, we should be good. So this is 941 and this is 851. So it's not too far off, but it's a little bit further off than I personally would like. So I'm going to use this one just because it is lower. 219 851. And let's see what this is as a percentage to figure out the vacancy loss. 993 divided by 219,851 times 100. So they're using 5% vacancy loss. So I can put that into my calculator pretty easily. And I'll notate it here, 5% vacancy loss. Okay, so if I were to divide this by 12, I would get 219,851 divided by 12 is 18,320.92 per month. Okay, so let's start punching in these numbers. So we are at 225, 1, 2, 3, 4, 9 units. Gross rents were 18321, 321. Property taxes, landlord insurance, I'm going to leave all that the same. Now I have to get net operating income down to or up to 12,145. So that means I have to add about 1,000 back in here. So let's see, 832, 12,129. This is not too far off. It's about $16 off. So what if I spend 0 on advertising? I'm at 12,139, so $6 off now. So where can I take off $6? Right here. What if I only spend $59 a month on water? And now I'm at 12,145. If I put 60 here, I will be at 12,144. And this should actually be 12,146 if I'm rounding up. So maybe put $58 here. And again, it's not about how these numbers are particularly distributed on this. What matters is that they add up to a total operating expense that leaves us at a net operating income of 12,146. On our DSC products that we do in-house, without brokering, we're not going to be able to do 9 units. We can broker it out and the interest rate gets higher, somewhere in like the 8s or 9s. So I generally tend to stay away from DSCR loans. This has a 5% vacancy. So let's see here. We require for our bank and agency loans to have a 90% occupancy rate and a 1.15 DSCR ratio. So the thing I like about Long Beach is that you see, even with the minimum down payment requirement of 25%, you're still hitting a 1.21 DSCR ratio. And that opens up so many doors for you. So we're looking at a down payment of $562,000 with a fairly low interest rate without having to buy it down. Your monthly payment's going to be about almost $10,000 a month, $9,900, and your cash flow is going to be $2,100 a month. Now let's see what the interest rate is going to be. It's going to be the 5-year CMT today. 3.842 plus, oh, it just updated to 3.844. So let's do that again. 3.844 plus 2.25. That's our spread. So we're looking at a 6.09 DSCR ratio. 6.094. And now we actually have to come down with 26%, assuming we were going with something like a Chase Bank loan. Now you'd get a lower interest rate there, but you're going to need a 1.20 DSCR ratio. Your down payment is $578, but if I stick at 25%, you're going to be saving about $16,000 there. So let's see here, 6.094. You've got $562,000 down, and you're doing about $19.27 a month in terms of cash flow. So let's start plugging in these numbers. Get rid of that window, get rid of that window, so I'm not accidentally clicking on things, which my regular viewers know I do. All right. And let's see, purchase price, property taxes 1.2%, realtor commissions. I had 8% on property management here. And easy way to tell that is to go 1466 divided by 18321, which is gross rents, and multiply that by 100. So you are at an 8% property management fee. We are putting 25% down here, 6.094. No rehab to any of these units. Now we got to figure out the yearly appreciation and the rental inflation. First, I also want to see yearly inflation over the past 100 years. So let's go to google.com. Yearly inflation over past 100 years on average. Well, let's see here. Average Kager formula. So between 3 to 3% and what I have here is 3.29. So it's from 1925 to 2025 is 3.1, but long-term average, which is what I like, is 3.29%, which is how I got this. So the longer the better, in my opinion, when it comes to figuring out inflation, because who knows what's going to happen in the next 30 years. So let's see here, average yearly appreciation rate over past 30 years. And zip code 90805, 90805. Kager formula. So let's see what this adds up to. So they are saying 6.16%. 6.16%. And now rental inflation. Average yearly rental inflation. They are saying it is 3.01. So before I even get into the numbers, inflation, that means costs of operating the building. This is where your yearly inflation is going to hit. It's going to affect the cost of operating the building, all your operating costs. That's going to be 3.29%. But your rental inflation, the rate at which you raise the rents to cover your operating costs, is only going to be 3.01%. So that's probably not a good sign. The only real compensating factor you have is yearly appreciation here. So just note that your costs are going to be rising faster than your rents. Your expenses, your expenditures are going to be rising faster than your income. So let's see, 9. So now we got to go back here and figure out the rent per unit. 18,321. So if we go here, 18,321 divided by 9, because this is a 9-unit building. See, 9-unit apartment building. 18,321 divided by 9. We are looking at 2035. 67 cents. So that's the average monthly rent per unit. 2035.67. I believe that's what it was. Let me double check. Yep. Okay. And so I've not even put in vacancy loss yet. We're going to worry about that later. I just want to make sure my cash flow adds up correctly. And this is a 9-unit building, so we're looking at about $9,900 a month or a year, $825 a month, 825 times 12, $9,900 a year. And now let's fill in all these other expenditures. Water is $58 a month. Then we have gas at 20. And again, this is not about the distribution, it's about the sum of the numbers. Electric is 80. I mean, I could technically put 0 for all this and just add it up into hazard insurance and then make sure that my NOI is equal to 12,146 per month. But I have it distributed here already, so I'll just use these same distributions. 120 a month for legal. Pest control is 180. Maintenance, I'm saying, is 832. So let's see here. What is that equal to? Maybe 4%. A little bit too little. 4.5. 824.625. 847. 55. 833. So we're pretty close over there. So let's see what else. 1466 for property management, 11465. So we are looking at 832. Trash is 250. Got all this. I believe I have all this. I have 0 for advertising. And so now it's saying 147,059. This is 145,747. So we need to get rid of about $2,000. So I need to add about $2,000 worth of expenses per year. So let's see here. 2,000 divided by 12 is 166.67. So now I am at 145,747. No, still a little bit too high there. So what if I go to 160, 139, 155, 150. This is 259. I need to be at 747. So let's say 140, 130, 120, 110. So now we're pretty close. We're at 145,739, and this is at 747,739. So now I can add in my vacancy loss. And now I can be pretty confident in these numbers here. And what we see is that first year we're already cash flowing at $13,000 a year. That adds up. If you were to take all the cash flow that you did every single year and just put it in a vault, put it under your mattress, you'd end up with about 1.1 million after 30 years. Now you'd have to pay taxes on that, but I'm going to show you how to worry about that later. So on that cash flow, you're going to deduct your mortgage interest write-off. You're going to deduct your building depreciation. And for the first 20 years, you're basically going to show negative income. So you're not paying any taxes on that cash flow. And also what that means is because of the appreciation rate here, which is 6.16%, which is a little low, to be honest with you. If we were to try to sell that building despite our cash flow after 5 years, we're not going to break even. We're not going to hit a profit. We're going to we're not going to show a profit. We're not going to break even. We're going to show a loss of up to $95,000, $96,000 all the way even into the 5th year. But by year 10, if we were to sell this building, we'd walk away with $429,000 in profit. But if you hold on and you sell after 30 years, and remember that cash flow that you had in a vault or under your mattress, you take it back and you add it into your proceeds from the sale, and you get rid of realtor commissions, you're looking at about a $9 million exit. So you're making $9 million on a $562,000 investment. That's not bad, but in terms of percentages, we're looking at about a 1,300% return or a 14x on your money. So if you were to multiply that original down payment, $562,500 by 14, 562,500 times 14. Wow, that's not good either. Let's see here. Let's say 14.13. So let's see, what is your total closing costs and everything like that? Maybe this one right here. So 718,969.62 times 14. That's a little bit too much. So let's see, what exactly are we dividing to get this thing? We're getting I-77 plus I-41. So I-77 is, no, sorry, we're dividing by B32, which is the denominator. So this will tell us B32 is our total spend right here. And we are looking at I-77 plus I-41. What is I-41? I-41 is our net equity. So what we're looking at is this number here plus this number here, which is these two combined, and dividing it by that. We should actually be using B91 over here, or I-91 on this. So let's go here. Yeah, we should be using I-91. So that lowers it to a 13x, 13.6x. So if I were to take this number here, right, the total spend, this is my cash investment, 718,969.62 times 13.6, I should get a figure that is close to this. And then I subtract this one, the 718 figure, minus 718,969.62. This is not making sense to me. So I know the numbers work. 9062. 9062259.28 divided by 718,969.62. So, and then I multiply that by 100, or yeah, 100. So that's 1260. Okay, So I see what's going on here. This is treating it like a percentage, and that's why how it's a percentage. Okay, but that's a 13x, 13.6x return on your cash, and I'll explain that in another video. But this is not bad, it's just not great. So what are we going to do? We're going to take this original cash investment here and add it to the balance of the loan to where we want to make sure it is 70% of the cash out or less. So let me see if I can explain this better. Loans are basically, it's something called loan to value. Loan to value. And it's basically the loan amount over the value of the building. And the smaller this is as a percentage, so if this is 50%, the smaller this number is as a percentage, the better. So 50% is better than 70%. 70% is better than 80%. And what do I mean by better? It means that for you as the owner, it's better because you have a smaller loan compared to your equity position. And when that happens, the lender rewards you by giving you a better interest rate. So what we want to do, when we bought this, we had a 75% loan to value, because with your 25% cash injection, we are at 100%. So what we want to do is lower your loan to value to a point where we can get a pretty good interest rate. And so in order to do that, we need to figure out at what point will the purchase price, at what point will your LTV be less than the maximum LTV? At what point will your loan be less than your max LTV? That's what we want to figure out right now. So on investment properties, when doing a cash out, commercial and multifamily especially, your max cash out is about 70%. Now purchase price is 75% LTV purchase. But on a cash out return or a cash out refinance, you're at about a 70% LTV. Okay, so we got to figure out when your total spend, your total cash investment, plus the balance of the loan. So cash investment plus balance of loan is less than 70% of loan, of value. And let's say future value. Okay, less than or equal to. So the way to do this is to look at your cash invested, 718,969, 718,969.28 or 0.62 plus the balance. So the balance can be thought of as whatever it says right here, the principal balance. I have that marked out here, right? And it tells you that year by year, so that you know that when you're making your monthly mortgage payments, you have your part of the payments going towards interest, part of the payments going towards the balance, and over the years that balance decreases, and so interest is being applied to a smaller amount, which means your interest payments go down with each payment and your balance payments or equity payments go up with each payment. And so the trick here is what I like to do is I just like to take the purchase price, because I know that this is X and has to be less than 70% of Y, future value. So future value, I can also just call it Y. So now that I have two unknown variables here, this gets a little bit harder to solve. So for example, if I knew that I'm going to refi in year 5, for example, I can just take that value from there, which is 3,033,000. So 3,033,000, oops, 3,033,800.84. So I can just start doing some simple math here. 70% or 0.70 times 3,033,800.84. That is equal to 2.1 million. $3,660, I believe that's what it is, .59. And so this is still plus X 718,969.62. And so X is equal to 213,660.59 minus 718,969.62. X is equal to 213,660.59 minus 718,969.62. That is when I have a balance of 1,404,690.97. So when I have this balance, I can do a 70% cash out. And if I look at my balance sheet right here, I'm actually not going to have that balance until year 10. So at year 5, I actually have a 1.47 or 1.572 balance. But in year 10, I have a 1.415 balance, which is still bigger than this, which means I should probably do it around year 11. But the value is also higher in year 10. So I know that in order to get this, I should probably do my cash out in year 10. So those are the numbers I'm actually going to use. So let's see here. Balance in year 10 is 1,415. Right? 1,415. 415. 725.87. And remember, this cash invested plus balance, so this is my balance. And then my cash invested is 718,969.62. Has to be less than or greater than 70% of value, future value. So that means I'm looking at 70% of 3853. 3853. 281.23. 281.23. And so what does this sum up to? So 718,969.62 plus 1,415,725.87. We are looking at a balance of 213,465.49. Okay, so let's see if that is true. if this is actually a good time to do it. So I'm just going to take this and divide it by 3853.281.23, and I should get a number that's less than 70%. And I get 55%. So if I were to multiply that by 100, I would get 55.39. Let's just round it up to 4%, which is less than or equal to 70%. So this is true. So refinancing, doing the cash out refinance in year 10 is the best time to do this building. So let's see here. So if I do that, like that, and I keep my equity here at 55.39, keep the same interest rate, keep the same inflation and all the other factors the same. Going to keep this price the same here. And now I just have to update the figures from year 10 and plug them into the start. That's what I'm doing here. So year 10, we are looking at hazard insurance of about $13,000 per year. Legal will be about $160 a month. Gas will be 321.17 divided by 12. So that did not work. 321.17 divided by 12. I keep hitting too many numbers. 17 divided by 12. 26.76. So that went up. 931.39. 931.39 divided by 12. 77.62. 77.62. And then we are on electric in year 10. So 1284.68. 1284.68 divided by 12. 107.06. 107.06. Lawn and snow, we are saying that is 1766. 1766.44 divided by 12. We are spending 147.20 per month. HOA and trash removal will be 4014.63 divided by 12 is 334.55. 334.55. Pest control is 2890. 2890.54 divided by 12 is 240.88. We're still spending zero on advertising. Maintenance base as a percentage has updated automatically. So we are looking at cash flow. So we are still cash flowing on this property. Despite doing the cash out refinance. So this is amazing. We rarely actually have this situation. Normally we experience a loss of cash flow even of a few years after doing the cash out refinance. So with this, we're still cash flowing our first year, but if you were to take all that cash flow and add it up, you're looking at worst case scenario, a cash flow of $68,000. And the reason for that is because the way this calculator calculates property tax values. Property tax values are calculated at 1.25% of the purchase price, but it's also calculated as part of the projected ARV price or the projected property value. So when we look at, property taxes as part of an operating cost, they're saying you're going to be paying $272,000 a year. And, California can always change its laws. California's voters can always vote to lift this. They don't know how good they have it when your property tax is limited to a maximum of 2% of the property value, or rather an increase of 2% every year. And remember, the property here is shown as an appreciation of 6.16. So if we want to know what we're actually getting as far as cash flow, we just update that yearly appreciation to 2%, and then we can see what our cash flow will be. It'll actually be closer to $2 million after the cash out refinance, the 30 years after the cash out refinance. So worst case scenario, you're looking at positive cash flow that sums up to roughly 90 of 68,000 added up. But if you actually factor in California's laws, then you're looking at something closer to 2 million. And so this is one of the rare situations where you can actually get a building for free. And here is your exit after 30 years. It's looking like 15 million after 40 years, because remember, the first 10 years you had the purchase loan, then in year 10 you did a cash out refi for 55%, 55.4% LTV, meaning you left a lot of cash on there. You got a very preferable interest rate. And even though it shows a $630,000 cash on cash, or a 630% cash on cash return, what's actually happening here is that you pulled out your original investment. So you're in it for $0. You're in this building for $0. So you've literally, after 40 years, you've just gotten a $15 million, $15.1 million building for free. That's amazing. That's amazing. So let's say all you had to do was worry about closing costs, right? Because there was a cost to refinancing this building. So we look at, your original investment, your original costs on refinancing this building as being $134,000, right? $134,864. So we're going to use this 15 million figure right here. So 15094,158.98, and divide that by 134,864. 134,864.84. And remember, this is not cash you've spent. This is something that's rolled up into the loan amount after you do the cash out refi. But that's 111x, assuming you want to count it as a cash expense. This is still a very good deal, even if you just look at it like that. So, yeah, until the next one.